Craig, and we've practiced you giving us the slide. So if you want to share your screen, we can get going.
Thank you, Angela, and thanks for the invitation to speak. I've read through the report summary from the dialogues that you held all of last year on resiliency across the city. And it's a very impressive piece of work, a lot of familiar themes that have that cropped up. And so I know that I'm speaking to a community that that's done a lot of thinking, maybe more so than most, on the impacts of climate change that we're already seeing all the way across the country. I've spent 2 decades in the Ottawa area, so I know the city reasonably well. But presently, I'm actually on the East Coast. I live in Nova Scotia now, in an area just south of Halifax that's prone to hurricanes. And apparently also wildfires and floods. Nova Scotia has managed to get hit with pretty well everything over the last year, and it just shows that every part of this country is experiencing the effects of the already baked in effects of climate change. So Angela asked me to speak to you today about several topics. And there we go. And what I'm going to do is I'm going to just provide a little bit of an overview on the National Adaptation Strategy, which was released last summer and is an important framework to be aware of. But more, I'm going to speak to the process that got there. I'm going to speak the main part of my presentation will be on insurance, market failures, and the protection gap, where how the financial sector is experiencing and reacting to climate change. And then finally, I'm going to talk about a very important area, defining and measuring risk, which is sort of it has proven to be basically foundational, and I'll get into the reasons for that shortly. But to begin with, I want to just speak to the cost of climate change. So this is a series of graphs that were put out by the Canadian Climate Institute that basically speaks to what we're experiencing. It's one picture of the risk, and this is circa 2020. But essentially, what we're seeing in Canada is that the number of weather-related disasters on an annual basis is increasing. And the graph on the right, the cost of those disasters is also increasing. There's another way of looking at this, which is just a sec, which is on a global basis. We're also seeing that the number of events above $1 billion per event is increasing around the world. So this is basically a global view from Aon, which is a global reinsurance broker. And what we're seeing is that essentially not only are we having more events worldwide, we're also seeing more costly events. And the trend, there's graph after graph after graph like that. In Canada, to give you a sense, our average insured losses in the period 2000 to 2009 was around $600 million per year. That went up and surpassed $1 billion a year by about 2016. And surpassed $2 billion per year in 2020. And 2022 and 2023, the industry paid out over $3 billion in losses. So that gives you a sense that the number of insured losses has gone up by about 500% over the last 20 years. And that's why the insurance industry has been so vocal and has been pushing so hard for basically a national response to make sure that we're developing a culture of preparedness in Canada. We advocated for back in 2021, before the last federal election, the development of a national adaptation strategy. The government committed to it in the election platform, carried through it, and went through a process over the last 2 years of basically developing a framework that would drive action for every order of government across the country in collaboration with Indigenous organizations, the financial sector, and provinces and territories. It's a really important document, and it was as important to have in that the development of it convened about 1,000 people across the country, all sorts of experts, on both acute climate risk and on slow onset events. So the acute climate risks is what we see in the news most frequently: wildfires, floods, extreme heat. Slow onset events are those that are going to affect us over time in this country, and that are also important, very important: sea level rise, drought, food security. And it essentially, the strategy covers most of these. Um, the idea is that it will be implemented through a series of 5-year plans. And what was key, and Canada was the first country in the world to do this. Uh, the strategy sets clear national targets for reducing risk. So, for instance, one clear target is we'll set up a national recovery framework to get people back in their homes within 2 years of an extreme event. Right now, we're very bad at that. So it basically sets that target, and that target drives all sort of all the actions that'll be needed collectively to get us there. There are targets around extreme heat, targets around wildfire risk, targets around flood risk. There's a whole range of them. And the document is now available on the Environment Canada and Climate Change website. Um, but for us, it was very important because it sets a whole of society frame that provides the context for what we want to achieve. And essentially, this is the process or the model behind it. And I think a number of these categories will be familiar to you because they emerged as themes in the dialogues that you held last year. You know, on the right is where we want to get to, less risk. So essentially talking about, no deaths from extreme heat in particular, reduced displacement of people after events, reduced damage. And in order to get there, we want to get to a point where both that communities are more resilient, whether it's the buildings that we live in them, whether you have the infrastructure that serves those buildings that you live and work in. And then there's a whole bunch of other sort of subsidiary targets around that measure resilient communities, and that are tied to getting to being resilient. But foundational to all of that is beginning with identifying who's vulnerable where. Making sure that we're putting the measures in place to protect them, whether it's emergency response mechanisms, whether it's community mechanisms, being able to identify your vulnerable neighbors, et cetera, whether it's building codes and implementing building codes, whether it's retrofitting buildings or making sure that new builds are resilient, that the infrastructure that supports them is resilient, and making sure that we've got community level resilience measures in place, including community resilience plans across the country. So there's all of these ingredients that fit together essentially in the framework. And right now we're very much on the very left-hand side of the graph, trying to get work underway. So I wanted to just start with that as an introduction before I got into insurance. So insurance for many is sort of a necessary evil. It's something that you pay in order to make sure that your car is protected, your home is protected. It's been around for about 400 years, originated after the Great Fire in London in the mid 1600s. And what insurance is meant to do is to distribute risk that results from unforeseen accidents. So it's really designed for accidents. If risk is predictable, and is not accidental, then insurance isn't a good candidate typically for it. The idea behind insurance is that insurers collect premiums, in exchange for taking on that risk, which means they underwrite, and then they invest those premiums to generate a return. And ideally, they maintain sufficient capital and liquidity to pay out claims and, because they're private companies, generate a profit at the end of the day. Um, Over the last 20 years, most insurance companies have not earned a ton of money. Typically the profit runs around 6 to 8% for insurers over time. Um, and uh, and so that's sort of a foundational view of what insurance is about. What most people don't realize is that insurers also seek and get insurance, and that's called reinsurance. And so your insurer will take the risk from you, your neighbor, people in the next neighborhood over. They'll bundle that, and then they'll pass part of that on to a global reinsurer, and they'll pay a premium to that global reinsurer in exchange for taking some of that risk off their books. The global reinsurance companies, they have names like Munich Re or Swiss Re or SCOR, and they're foundational to being able to carry financial risk, um, and uh, and they have been affected as a result of climate change. So the challenges that have emerged in the last decade is that worldwide, we're seeing more catastrophes than there is capital available to reinsure against. That means that there's a finite supply of reinsurance out there, meaning the pricing for reinsurance is actually going up. Back in around 2019, reinsurers began to change their pricing strategies because there wasn't enough to go around, essentially. They began to pull reinsurance capital from the most risky areas of the world. And in fact, Lloyd's was the first to do this, and they pulled out of Canada in 2019 because Canada was seen as a more risky part of the world to do business, and they were losing an inordinate amount of money in Canada and in some other locations around the world. That caused a lot of difficulty in this country because they were the number one commercial reinsurer, which meant that a lot of establishments like houseboat operators or often hotels or restaurants couldn't get insurance because there was no reinsurance in that area to back them. Other Lloyd's actually ended up coming partially back into the Canadian market, but now other reinsurers are doing the same thing. They are beginning to pull out or restrict capacity in certain parts of the world, like California, Louisiana, Florida. And as a result of this, insurers are now, because they can't pass the risk on, or it's more expensive for them to pass risk on to a reinsurer, insurers have a decision to make. They can either pass on those property premiums, those increased costs to their customers, or they can tighten their own capacity in certain markets. And this is happening right now for earthquake coverage, for instance, in British Columbia. Um, there are also other reasons why insurance rates are going up. So your insurance premium is often based on the cost of rebuilding your home, so making you whole after an event. However, due to inflation, the cost of materials has gone up dramatically, and construction labor is now in short supply because we're attempting to build so many homes across the country to meet the affordability crisis. It's meant that we don't have, it can be difficult to get contractors, and the contractors you can get are much more expensive. So when an insurance broker projects a rebuild value, often it can be actually more expensive to rebuild a house than the market value of the house itself. And that means that it's not just the price of the reinsurance that's exerting pressure, it's the rebuilding projections that's exerting pressure on insurance premiums as well. And what happens as a result of this is that insurers are deciding not to cover certain perils because so let me back up. So this overall and worldwide has led to what we call protection gaps, and protection gaps can emerge for several reasons. One is that insurers decide not to cover a peril because they can't model it. They can't model the risk. Or they decide not to cover certain regions because uh, the risk is simply no longer accidental, for instance, floodplains, and or reinsurance costs are too high, and or price regulations mean they're going to lose money for sure. There's no way that they can recover the price of reinsurance by passing those costs on to customers. And this is what happened in California when insurers last year stopped writing new policies. A number of insurers stopped writing new policies in California. Insurers also adjust products to keep the premiums affordable. But what ends up happening is the same as what you're seeing with those bags of chips in the grocery store, where the bag of chips may cost the same, but the bag has shrunk.
Mm.
And so what ends up happening is the insurance protection actually shrinks, higher deductible, lower coverage limits, increasing exclusions, and that provides consumers with making an opportunity to make a deliberate choice to protect themselves inadequately. So, what the result of all of this is, and the trends that we're seeing and that we're trying to guard against, is that we're ending up with some market failures. So, first, consumers often misunderstand their insurance coverage and end up being unprotected, such as with flooding, or they misunderstand the risk. They don't realize how high the risk is for them, and they're unprotected. Again, flood or earthquake in Quebec. Consumers are inadequately aware of their risk and believe it's not worth the premium they're being charged. Or government disaster assistance competes with insurance, so homeowners expect bailouts and don't protect themselves. And this is happening across the country now, where if insurance is expensive, people think, oh, well, government will bail me out anyway. Why would I buy insurance? It's important to note that wildfire, hail, wind, all are core to property insurance policies, and therefore we don't actually have market failures in those areas. So, because of these, the insurance industry approached the government of Canada back in 2017 and said, look, we've got some big issues in this country and we need to address them. We're projecting that there's going to be less reinsurance capacity generally, and we're seeing market failures in certain parts of the country for certain perils, flooding being a key one. And the way that other countries have handled this is to create public private partnerships essentially between the insurance industry and governments, where the government then steps in and says, okay, we're going to end up offering insurance or backstopping insurance and making sure so that it enables you to then provide it to high risk customers. And this is happening right now in Canada. You'll see it's been in the news. It'll be in the news quite a bit over the next month or two that we're working towards standing up a new program, high risk flood insurance program for the country, to make sure that residents, no matter where you live in Canada, will have access to flood insurance. But at the same time, it means withdrawing from publicly offered disaster financial assistance. I won't go through this in high detail in the interest of time, but essentially it's a good news story because it enables people to protect their greatest asset, their home. There's about 1.5 million Canadians that live in high risk areas across the country that can't get flood insurance now. And that are at high risk if it should happen. For those of you that saw Hurricane Fiona a year and a half ago, that has swept through PEI, Port aux Basques, Newfoundland, and Cape Breton. Those homes, a number of them weren't insured, and people lost everything when they lost their home, and that's what we're trying to guard against going forward, given that we're seeing these events more frequently now. So having given you that insight and having thought about the national adaptation strategy, where we're headed is how do we do a better job helping Canadians understand the risks that they face and helping both the Canadians know what measures they can take to protect against that risk, or their community or their communities, their municipalities, taking measures to identify high risk areas and taking the appropriate steps. And the key to all of this really is incentives. How do we make sure that people are rewarded for good behavior? So in order to talk about that, we need to talk about risk measurement. So when we talk about risk measurement, we talk about two key topics. One is, and I've got about 4 minutes left, Angela. The first is the risk of a structure to a climate peril due to its location. We call that hazard, your flood hazard. The risk of a structure to a climate peril due to its physical characteristics. We talk about that in terms of exposure, the exposure of a house or a building to flooding or to another peril. And then finally, the risk of the homeowners, the people themselves, to a climate peril due to their socioeconomic health and other characteristics. That's their vulnerability. So you can have two neighbors, both of who are highly exposed, but one who's much more vulnerable. One who's better off can better withstand the financial loss, and the other one can't. So when we talk about climate exposure, and that's where I'm going to focus on most, there's not a lot that you can do about the hazard. The hazard exists whether you're there, you're in harm's way regardless. So the question is what you do about it. You can intervene at the property level or the community level. At the property level, you can take the steps to basically um, uh, inoculate your house in part to a climate risk. This is a great example from Hawaii. It was a couple from Massachusetts, moved in 2 years before the fire hit, knew about fire risk, basically took a number of measures to upgrade their house for wildfire resistance. And their house miraculously was the only one left standing when that wildfire hit Lanai last year. And then, so those are property level mitigations, what things you can do at the property level. And then at the community level, obviously investing in flood defenses. This is the best example in Canada, the Red River floodway in Winnipeg, which is a massive investment, $60 million back in the 1960s, but has probably averted over $1 billion in flood losses ever since. And so when you're thinking about measuring risk, you need to think about a combination of these elements. So there's the hazard, then there's the community exposure and the property exposure. So you can be at high risk of flooding, such as people in Winnipeg, but their exposure has been dropped to almost nothing because of that investment at the community level. Similarly, you could be at risk of wildfire, relatively high risk, and yet you can take certain steps to reduce that risk at the property level. So it's like you've got several levers to play with. The thing is that we don't actually have a measurement framework, and this gets to the left-hand side. Some of those foundational pieces, we haven't identified who's at risk where. We don't have the labels or the standards to basically, it'd be great if your house, you could say, yeah, this particular house, when you buy it on a real estate system, real estate on an MLS or realtor.ca, you can say this house is has medium exposure to wildfire, is highly exposed to wind, and you have some sort of rating system on a home. That's where we ideally as an industry want to get to. If you have that label, it provides a mechanism for homeowners to understand their risk and to measurably address it. It helps us as an industry maintain that insurability over time. It allows us to provide incentives. So whether it's insurers offering premium reductions, banks offering mortgage incentives, realtors being able to disclose risk, we need to come up with that sort of risk measurement framework. Labels, as we know, can drive behavior. So we do it on nutrition, we do it on energy efficiency. We need to get there on climate resilience. We know what to incent through these sorts of labels. We know the types of things that will make a difference. This is a graphic from the Institute for Catastrophic Loss Reduction at the University of Western Ontario. And they basically lay out, for insurers, the biggest things that matter, doesn't matter if you're talking about wind, hail, or wildfire. It's what is your roof made of and what is your siding. And then there's a whole bunch of other little elements around that. But those are the two primary things. And no matter if you have home insurance, your home insurer knows the construction of your house, and your premium is based on that structure. And it varies depending on where you live. If you're in Calgary, they pay much more attention to the roof because of hail. If you live in Ottawa, they're probably thinking a little bit more about flood these days based upon the events, and wind based upon the events that happened recently. So, in summary, to pull all this together, the costs of climate change are escalating more quickly than we've anticipated, much more quickly than we anticipated. We're witnessing events now that our models did not project. We didn't think that these sorts of events would be happening for another decade or so. We now have, though, a national framework to drive resilient action, and that's that national adaptation strategy. Given that framework, all orders of government in the financial sector should be collaborating and work together to address risk. We lack some of the most basic tools so far, though, to drive behavioral change, tools that exist in other spaces like energy efficiency. We need to get there. And if they existed, these tools would allow insurers and municipalities to measure community exposure and factor those into insurance premiums. So, in other words, reward infrastructure investments. So hopefully I provided some thoughtful detail, and I'll wrap it up there and turn it back over to you, Angela, for questions.
Okay, that was quite a content-filled, super high-level tour of where we are. So I'm going to use the moderator's privilege to try to bring this down to sort of the residents on the ground perspective. I'm going to ask you a first question, and I want James from the City of Ottawa Finance Department to be thinking more at the infrastructure, municipal, financial sustainability level, right? Which is where he's coming from. So if I'm a homeowner and I'm saying, okay, I've heard about these backflow valve things. I've discovered that I don't have one. I don't quite know how to discover that, but the City of Ottawa is actually all set to do a makeover of our protective plumbing program. So we're going to have more clarity on how residents can use this program. So say I decide, okay, I want to be climate smart. I'm going to invest. I'm going to run after the subsidy that the municipality will even give me. So how do I then turn around and tell my insurance guy, hey, I've done my bit. I'm now a low risk compared to my neighbor who remains oblivious?
So your insurer, through their broker, will likely ask you if you've installed those. So they will. So what happens in the background is an insurer basically takes a look at a map and says, "Are you in a high risk area?" In this case, for storm. For sewer backup, which is what those devices are meant. So if you're in a low-lying area of the city where the stormwater system is going to get overcharged, and therefore your home is at a risk of that water backing up into your house, they will say to you, Angela, you're at a bit of risk. Have you installed one of these preventers, backflow preventers? And if you say no, then they will say, well, we will give you an incentive, which is a premium reduction of a certain number of dollars, if you install it. Not all insurers do that today. A few of them do. Where we need to get to is a systematic approach where you're being offered to it no matter what insurer you're with, and you know the result that your home will go from medium risk to low risk. We need the measurement system, and then we need sort of a more standardized approach on the insurer side. We're getting there. Those conversations are active right now.
Okay, so once again, I'm hearing that you have a pretty clear idea of where we should be going, but it's not quite in place yet. So I think that here in Ottawa, which is where the CAFES network is active, where our members are, we will pursue this, because it's my understanding that flooding is the most important risk, more important than fire. And we notice lots of fires. And in Ottawa, we had significant overland flooding last summer. I will now invite James to give some of his perspective, looking at this from the City of Ottawa point of view in terms of climate risk, and also pose a question or two to you, Craig. And after that, we're going to open it up to other attendees in this meeting. So over to you, James.
Great. Yeah, what resonated for me was the example in Winnipeg there about the community level investment, and how probably an investment at say that municipal scale can do a lot of benefit, more so than individual property owners in that example doing their part. So that's that's a really interesting concept that I think municipalities have to be aware of, where they can what those community level risks are. And I know the City of Ottawa is coming out with their climate resiliency strategy that's going to list a number of actions to address resiliency. So I know that's I think that's been posted now, and it will be going to council eventually. But I know that is our big first step at the city to do more of this type of thinking about sort of that community level projects and investments. I had a question for you in terms of how would you divide, on your one of the graphics, you had something about resilient buildings and resilient infrastructure. Can you explain what a resilient building is, and what makes a building become resilient? How do you measure that? And same with infrastructure. What would you define as infrastructure that's resilient versus not resilient?
So that's a great question. In a way, it's the $1,000,000 question. We don't have the definitions for those yet. We don't have the widely agreed definitions yet. Insurers will say, a building is resilient against hail if it's got Class G shingles on the roof, and that's probably what it takes. It will be resilient against wind if it's got hurricane straps that are connecting the roof joists to the house, because that's the greatest danger, is the roof lifting off. But we haven't systematically gone through and said, let's define resilience. And for that reason, the Institute of Catastrophic Loss Reduction has just launched a task force between insurers and the Canadian Home Builders Association to, at least on the home level, come up with that label. So that work is underway. But on the infrastructure side, we're not there yet. So great question, though. Angela,
James, do you want to take it a little bit more at the municipal level?
Yeah, I mean, what's behind my question is, I think municipalities are looking at climate mitigation, but also climate adaptation, and that old cliche, what gets measured measured gets managed, and it's something I think a lot of municipalities we have good metrics on the climate mitigation side in terms of measuring greenhouse gases, and there's a lot of robust calculations that go into that. But on the resiliency side, it's a lot harder to land on that metric, and that's one of the cornerstones of our climate related financial disclosures is the metrics and targets section of the TCFD. So yeah, if there's more progress made in sort of defining this, I think it seems small, but I think it will make a big difference.
Yeah,
Do you
the
want to
other
comment on that, Craig, how municipalities are measuring climate risk?
um, so we have some examples of how municipalities have gone out. So the City of Edmonton's a great one, where the City of Edmonton actually secured the same flood maps that the insurance industry uses, and then used those flood maps to basically determine where the hazard was, the unmitigated hazard, and then where they could get the best bang for their buck, and basically return on investment based upon infrastructure across the city on deploying flood defenses. So they basically informed their stormwater management plan by using those hazard maps. So there's good examples out there. Every city is kind of innovating in their own way, or a number of them are innovating in different ways. But I don't have a comprehensive list of examples. I will say though that where we, and this is to James' earlier point, where ideally we need to get to is insurers also have an interest in funding resilient infrastructure. And in order to fund resilient infrastructure, we need to figure out what that resilience value is. I quoted the City of Winnipeg in the Flood Info Way, where we have been able to measure what the resilience value has been of the floodway against its original cost. And so there is effort underway by some investment arms of insurers to say, how can we do that measurement? How can we measure if you're going to put in a dam, for instance, or you're going to put in a diversion area, how much loss is averted, and we can quantify this based upon the value of the buildings downstream, based upon the expected occurrence of a flood events. How much are you actually saving in terms of losses averted over time? And then how can you turn that into an investable instrument? And so that's work that is just underway, but could be really important work, getting to something that James had mentioned earlier.
Mhm. Interesting collusion between the insurance companies. Okay, so let's open it up to the floor. And I think, Teresa, you are first in line.
So my question is, you're talking about climate resiliency. So there are a lot of natural bulwarks. So if you have, for example, wetlands, or you have forests, or you have, like a lot of vegetation and so on, then these act to reduce the amount of flooding. The trees act to reduce, act as windbreaks. You have like vegetation, shoreline, undeveloped shoreline, which acts to prevent landslides and like additional flooding and so on. So is that um, assessed? So let's say if someone could take the city of Ottawa and say, here are all these wetlands and whatever, let's put a value on them. So not just man-made things, but things that are already there. And then by doing that, they are protected. Like there's no way that a developer can say, oh, but we need to build more housing. Let's, mow down that tree. And I mean, there are existing woods and so on that are being cut for whatever reason. So if there's a value assigned to each tree and it's, measurable, then I'm sure that would help. And it's free as long as you protect it.
So, really important point. We know that, for instance, the wetlands upstream of Ottawa probably attenuate about 10% of the flood risk. That's the number that we came up with in consultation with the three conservation authorities around Ottawa. We know that there is significant value in those wetlands remaining intact. There's been quite a bit of dialogue around the Goulburn wetland, for instance, as a case example. However, at this point in time, we don't have a mechanism to even measure regular infrastructure, much less what we would call that natural infrastructure. But we need to get there. We need to figure out, how do you capture and quantify the storage value, for instance, of a wetland in a spring runoff event, and how much loss that averts because it exists. And then how do you use that knowledge to pay for the conservation, maintenance, restoration of those features? Ottawa is a great example of a place to start. We've been trying to get projects off the ground across the country in that area. We launched national consultations on it about 3 years ago, but it's been difficult because we don't have that measurement framework yet.
Thank you.
Okay, measure. I think that that's something that a whole bunch of different sectors can get behind, including CAFES very much so. Kira, you're up next.
Hi, yes, thank you, Angela. Really interesting discussion and presentation. Thank you so much, Craig, for everything. And I've resonated with a lot that has been said. The conversation with James kind of links into what my question is. I was this last fall at an event, and I had the chance to speak to someone who works in sustainable construction. And a big theme that kept coming up for us was, even if we, in theory, understand what it takes to create sustainable and resilient infrastructure, we're living in an economy where going to developers and asking for that to be implemented is just not really realistic right now, just from a funds perspective, right? How can you ask a developer to implement resilience or sustainability in a way that is costly? There are a lot of plans to make that happen, payment plans and ways that this can be paid off. In terms of insurance, how can we sort of shift the industry towards investing in long-term sustainable infrastructure? That's something that sort of kept coming up in the conversation. Is theoretically there are a lot of good ideas and there are a lot of great people on the ground doing the work to make these ideas realized. But when it comes to the private industry and actually convincing developers and many different industries to implement these ideas, what are ways that we can try to inspire that change?
So and I hate to sound like a broken record, but it'll come back to that label idea again. You have to create the market demand and then the measurement mechanism so that people will put a value on the more sustainable or resilient approach. So an example of this is seafood. There's a seafood designation, Marine Stewardship Council seafood, for instance, and a few years ago, Loblaws and Sobeys, because of market pressure, switched their buying practices to say we will only acquire from MSC sources because that's what our customers want. But how did you determine what sustainable seafood was? You needed that label, you needed that approach, some sort of designation or certification. We think that that's probably how we're going to get there with resilient, sustainable housing. We've got the energy efficiency label, and that exists on whether it's an appliance or on housing. We need to get there on the resilient side as well. So if we have a resilient label, if you live in Nova Scotia right now, you're worried about wind. We've had 3 hurricanes in 2 years. People are essentially saying, I'm not going to buy a house until I know that it's been built to be wind resistant, because otherwise my insurance costs are going to be too high, and frankly, my losses in the future are going to be high. So the market demand is driving it, but we have no way to label whether a home is wind resistant yet. So your question, I think, really grounds that as an example. That's what that we see this measurement framework as the way to get to that sort of defining sustainability.
Interesting. Thank you so much.
Okay, so I would like to interject that we have energy efficiency labels for our washing machines and for stoves and for probably like hair dryers, but we don't have them for like residential buildings here in Ontario. And the Ford government, with great glee, ditched the sort of legislative runway to that. So having home energy, home carbon efficiency labeling alongside of home resiliency rating labeling, I guess that's where we want to go. At this point, I'm not sure whether even detailed flood hazard maps are made available to residents. So if you want to buy a house, I'm not sure. You'd have to dig pretty hard before I know the data exists, but I don't think it's very easy to find in Ontario. All right, so next on the list we have Letitia.
Hi, thanks. This was a very informative presentation. Thanks very much. I'm a little bit aside from the specific topic and going back, wondering why, if the insurance companies in Canada could predict these risks that would damage their business to such an extent, why there wasn't more pressure on the government to look at mitigating the impacts of climate change rather than looking at adaptation and resilience. Why do you think the government really was so reluctant to act, to impose lowering carbon emissions on fossil fuels, for instance? And what can we as citizens do to push our government to do that, in your opinion?
Well, you have a vote at the end of the day, making sure that whether it's your municipal councillor, your provincial MPP, or federal MP, making them aware of your views. I mean, that's going to be really important. Unfortunately, the political dialogue has focused on carbon pricing and carbon tax, and that's done a couple things. It has equated the climate change debate with only one measure, which is frankly a consumer carbon pricing mechanism. And that fight over the last 7 years has sucked out the oxygen from the room on a bunch of other very important topics, including resilience, to the degree that there hasn't been enough debate and enough thinking about how do we protect Canadians and their communities, and there's a whole bunch of other measures on emission reduction that could be effective that haven't received enough attention. And if you're interested in that specific argument, the Canadian Climate Institute, which is probably the most reputable think tank in the country on climate policy, just released a report this week on this very topic, and it's a really important read.
Okay, really good question, and thanks for taking that on as well, even though you are not the federal government of Canada, Craig. Next, we have Mike Fletcher.
Thanks, Angela. Craig, maybe the next question is going from recognizing you're not the government to recognizing you're not in charge of the insurance industry. But given that the insurance industry so clearly understands the risks from the climate being destroyed, why are they investing so much money in fossil fuels?
So a number of insurers have actually divested from fossil fuels, starting with coal, including thermal coal, and we're seeing that transition underway. In fact, there's been a significant amount of tension in the past between the government of Alberta, of Alberta, and certain insurance companies, because they've made the decisions to no longer invest in the oil sands, for example. And so, you're always going to have a spectrum in any sector of companies that are more progressive and other ones that make decisions for other reasons. But we are seeing a trend towards both divestment and frankly refusing to insure or underwrite carbon extractive operations. So it's up to every company and their own strategy and their outlook. But we have seen that there has been a reduction in insurance capacity overall for those sorts of projects.
Okay, it'd be nice to see the graph on that, right? All right. Next I have Anthony Leaning.
Hi there. It's actually Rebecca and Anthony, but I'm the one who has the question. And I just want to reiterate, Craig, and everybody else who's participating on this call, great conversation, great questions. It's amazing to see the knowledge and the insights that exist within this community. Craig, a couple of things. First of all, I just wanted to say, and I know you're very likely aware of this, but Ducks Unlimited, the insurance industry, and conservation authorities have actually invested quite significantly in the last 10 years in research on ecological services, in wetlands, water retention, et cetera. So, we're not at the very early stages of understanding how important and valuable it is to retain that natural infrastructure that protects us against losses. So I think it's really important to kind of acknowledge that the instruments that we develop to both incent the protection of those existing natural assets and to sort of build and invest in restoring those natural assets or creating additional bulwarks against risk is a really interesting question. And I'm very glad to hear that the Canadian insurance industry is thinking about that. So those, obviously could include things like reestablishing vegetative barriers against flooding, for example. How do we actually create insurance instruments that reward investors for making those kinds of investments? And I think that there is, some work that is being done now to try to develop those instruments. And as that work is going on, I hope that the insurance industry is also thinking about the potential to invite kind of retail level investment in those kinds of instruments, because I think, we have in Ottawa, for example, the Ottawa Renewable Energy Co-op, which is one of a very few opportunities for individuals to invest in things that they want to see happening in their own communities. And I think these kinds of resilience mechanisms, through insurance instruments, could be another really great way to allow people to invest in things that they feel will build the resilience of their own communities.
That's a fantastic comment. Thank you. We had not thought about that retail investment approach. We've done a fair amount of thinking about it, but we haven't thought of that angle really, or at least I have, maybe others have, but I haven't. Really, really important comment. Appreciate it. I live in Mahone Bay, which is an hour south of Halifax. We have a living shoreline now, a project where saltwater marsh grasses have been planted instead of the armored rock wall in order to attenuate wave strength during hurricane events. It's the first demonstration on the East Coast of it, and it was paid for almost entirely by Intact Insurance, even though they don't have a commercial interest in the town of Mahone Bay. So, terrific project. They invested in it, and it's a demonstration project, and we're monitoring the results of it. So there is some good work underway, and informed by groups, obviously, like Ducks Unlimited. But we need more of them, a lot more of them. And being able to attract or put the framework together to attract retail investors or any sort of investor is a great angle. So.
Very interesting. I by accident, because I was hanging out at an environment committee meeting, the municipality, speaking of incentives and vegetative and more permeable investments, the municipality is looking at a revamp of how they assess our stormwater taxes. Like we pay like rate fees so that we as residents end up paying for our stormwater management. And the city of Ottawa, the municipality, is going to switch to a system where if you pave over all of your property, you're going to be paying way more for your stormwater. And this is coming. It's also one of these things, as you're saying, Craig, there are tools and approaches that are smart and thought through, but not yet in place. And so, Rebecca, that also comes a little bit at your question again, in terms of like incentives for like vegetative green infrastructure and more permeability based ways of managing stormwater. So we are at 7:31. So I'm going to give a last quick question to Stéphane Laviolette, and then we need to wrap up this very interesting discussion. Craig, if you're willing to have people ask you interesting questions, you can put your coordinates in the chat. We are definitely having the permission of Craig to circulate his deck with all that richness of information. So you'll be getting that in 1 or 2 days if you have RSVP'd, which everybody has, otherwise you wouldn't be in this room. So last question to you, Stéphane.
Angela, and thank you, Craig, for the great presentation. I just wanted to go back on the question that Mike asked 2 questions ago on the investment in fossil fuels. The financial sector is a major driver of climate change through those, financed emissions. And there's a growing movement across the world, but also here in Canada, to adopt climate-aligned financial policy. And Canada is definitely lagging behind our major partners, including the EU, the UK, and even the US, which is oddly more advanced than us on that front. And all we've seen in Canada so far is the Office of the Superintendent for Financial Institutions doing those, I would say, very slow moves of trying to, just get disclosures going, which that is not enough to change anything anyways. But is the Insurance Bureau of Canada advocating for climate-aligned finance policy in Canada? And I'll give an example. And I don't know if you've heard of it, but Senator Galvez introduced Bill S-243, the Climate-Aligned Finance Act. Okay, I see you chuckling, so you must have heard about it. In the Senate to help the financial sector, align. So I'm wondering what the Insurance Bureau is advocating for.
Not only are we supportive, but we set up the actual event involving the Prime Minister's office and then Minister McKenna to hear from international experts on why we need a sustainable finance approach in the country. That event that IBC organized, that event led directly to the establishment of the expert panel on sustainable finance that Tiff Macklem chaired back, I don't know, whenever that was, 2019, 2021. That led to the implementation of the TCFD framework and OSFI, basically the political direction to OSFI and to Peter Rutledge there to start to prioritize it in the country. Yes, the work on SFAC, the Sustainable Finance Action Council, that came out of that work has been going way slower than anybody expected. There hasn't been enough support, as Senator Galvez has pointed out. There hasn't been enough support for it out of Finance Canada. But we've been, yes, behind the scenes and in front of the scenes, in fact, advocating for it and participating in it, for a number of years now.
Okay, only in Ottawa will you get questions about what about this initiative driven from the Senate. So thank you, Craig, and thank you, James, very much for joining us for this keynote portion of our AGM. It's been really, really interesting and like at so many different levels. Thank you, and please keep up the great work. And both of you guys at municipal and at national level.
Thanks, and thank you so much for the invitation to participate. I know there's a ton of questions in the chat that we didn't get have time to get through, but yes, happy to engage at any time. Thanks, Angela.
Okay, bravo. All right, so what we're going to do now is we are running a couple of minutes behind, but I still want to give everybody a quick chance to go get a glass of water or to take a quick washroom break, or maybe even to rush off to the kitchen, grab yourself something to eat. If you haven't had dinner, just come back in a few minutes, and then we will start the official business portion of the meeting, which will be chaired by the other James Stevenson, who is currently the chair of the board of CAFES. So we'll start in about 3-4 minutes at 7:40.